Hi, I'm Janine Firpo, and I'd like to welcome you to the sixth of our 12 Fireside Chats that we're having in advance of the publication of Activate Your Money, Invest to Grow Your Wealth and Build a Better World. Today, we're going to be speaking about public equities, the stock market, which is an area that many people know about and most people are invested in. But there's actually more to know about public equities than I think many of us realize. And we're going to talk today a lot about how you can invest in this asset class in a way that aligns with your values. And as my guest today, I have Lauren Sercu, who is a chartered financial analyst, as well as the general manager at SEMBA Capital. So she was very instrumental in helping me write this chapter. And I really look forward to this conversation with her. So I'd like to invite and welcome Lauren. Hello.
Hi, Janine. Well, thank you so much for having me. And I'm thrilled and excited to be here to talk public equities.
Well, great. I mean, one of the things that you do is you are the head of impact strategies at your firm. So what I would love to know a little bit about is what does that mean for you? And what is it that your firm does with your clients to help them invest in alignment with their values?
Sure. So SEMBA Capital is an institutional advisory firm and multifamily office with offices in San Francisco and Salt Lake City. And yeah, I lead our impact investing practice. So what that means is I work with families and institutions to understand their values and understand their investment goals and marry those two together to build and construct portfolios for them. And then I also lead our impact investing research arm, which actually does the work to identify and select investments that go into the portfolios that we're building for clients. So really kind of running that whole impact investing chain. And I think it's very hard to paint with one brush exactly what impact investing means. We really take impact and values mean everyone has their own set. So we really start with each client and understand what matters to them and then build a bottoms up portfolio from there.
So I love that you say that because that is to a large degree why I started calling this kind of investing values aligned investing. I mean, in the world out there, a lot of people talk about it as social investing or impact investing. And I think it's so personal and it's so related to what our particular values are. So I love the fact that you talk about it that way too.
Yeah, no, and we say at SEMBA we have this line that sort of moves us in our values aligned practice, which is that if you know one client's definition of impact or values, you know only one client's definition of impact or values. It's a really, really highly personalized field in finance, which is often a field that can be very automated or standardized. So definitely a personalized approach.
It's great. And I know for a fact that at least one of your clients is a faith-based organization, which I find really interesting as well, because people of faith, of a variety of different faiths, live their values, and to be able to start thinking about how to move their money in alignment with their values, I think is also important. And one of the things that I don't think a lot of people recognize about this kind of investing is that Catholic nuns, of all things, were some of the earliest, biggest proponents of this type of investing because they didn't want to see their money supporting things that they were working against in their lives as nuns. So I think it's really interesting that you are working with those kinds of organizations as well.
Yeah, we're lucky enough to work with a mix of foundations and other nonprofits that are doing really charitable work, as well as families who are giving and making charitable donations. And often, Janine, it's exactly what you're talking about. It's this idea that traditional investing and traditional philanthropy have to be very separate activities. And I think a lot of our clients have kind of looked up and realized, wow, we're doing such good work on our philanthropy side. How do we multiply that impact? with our investment dollars, instead of, in many instances, have investments that are working against what they're doing on the philanthropy side. But yeah, this industry has really amazing roots. Leave it to women to have started investing with their values.
Yeah, no, I love that this started in large part with women. It's great. And in the asset class that we're talking about today, which is the public equities class, there are literally thousands of different choices in terms of the kinds of investments you can make in the stock market, whether you're investing in individual companies or whether you're choosing to invest in stock funds that you can make that are values aligned. So how do you go about looking at all the options that are out there, all the choices that are out there, and defining what it is that you invest your clients in? What are the criteria that you use?
I mean, it's a big process. The first, again, it's highly personal. So we start with what are our clients' values and what are their investment objectives, and what's their risk tolerance. So you really need to be able to understand each investor's parameters around what matters to them, both financially and from an impact standpoint. And then from there, we're able to canvas the landscape in both kind of a quantitative and qualitative way. So from a quantitative standpoint, we're often running screens, looking for strong ESG metrics and sustainability of performance as well. And then from a qualitative standpoint, we're doing kind of much more touchy-feely analysis. So meeting with the portfolio managers, understanding what drives them, what matters to them, and trying to see if that's aligned with our clients. So it's really both an art and a science in terms of selecting the investment managers that we end up putting in client portfolios.
It's really bringing the heart and the mind to your investments, just like we bring the heart and the mind to our lives, right? And you talked about environmental and social. When people think about this kind of investing, a lot of what we see in the news is around ESG investing, and it applies a lot to the stock market, environmental, social, and governance. There's also been a lot of conversation around the issue of greenwashing. So could you just explain for a moment what greenwashing is?
Sure, I'm happy to. So greenwashing is a term that's used to describe companies that might be sticking a ESG or impact label onto something that isn't necessarily generating a lot of authentic environmental and social good or positive impact. And so really, I think greenwashing is something that we really have to be mindful of, particularly as ESG gets more and more interest. So clients are wanting this. And so a lot of different investment managers are realizing, hey, there's a real opportunity here to expand our product lines and sometimes do really, really strong, authentic work about incorporating ESG and impact into those investment strategies. There are lots of phenomenal strategies out there, but there are also some groups that are taking advantage of the growth of this industry and taking some shortcuts that aren't necessarily delivering that truly authentic ESG and impact that clients are looking for. So definitely something you want to be mindful of when you're thinking about investing alongside your values.
So there was actually a really interesting exchange that just took place over the last week or so in the news. And first there was a piece in USA Today by a gentleman named Tariq, and he was a former chief investment officer at BlackRock, which is a very big institutional investor. And he basically said, look, I worked inside the industry. I was there. I saw it. This is all greenwashing. That's all it really is. There's not any real there to the ESG story. And within a week, there was a piece that refuted that by a gentleman named John Hale, who is the global head of sustainable investing at Morningstar, which is a huge financial player as well, and really a research giant. So I find this really interesting that there's so much controversy around this issue in the news. I have a lot of respect for John Hale. I think that he does deep research. His pieces are very thoughtful and they are backed by a lot of facts. But I'm wondering if you saw these pieces yourself and what you think about this conversation that's going on currently.
Yeah, I did see those pieces, Janine. It's very interesting and very timely. I think we've seen a lot of these types of arguments ebb and flow about ESG. And I think Tariq's points, many of them were well taken. I think it's very, very hard to paint the ESG universe with one brush. And I think this just goes to exactly what we were just talking about around greenwashing is you really want to do your homework in this space. And you want to look for folks who are doing this in an authentic way and reporting back to you as investors on what ESG change and impact change they've incorporated into their portfolio. So really looking to specific metrics on how they're delivering to you as clients. And I will say, Morningstar has actually a really strong and increasing body of research around ESG performance that is actually really positive. So there is a study that Morningstar put out recently that looked at 20 years of data on 20 ESG funds and non-ESG funds for different regional equity strategies. And 16 out of the 20 funds outperformed, or ESG funds outperformed. So we're really seeing mounting evidence that environmental social governance investing matters and that it's full information investing. And that when you're just doing your kind of nerdy quantitative fundamental analysis that's important, that should play a very strong role in how you pick stocks, is not everything. That understanding how companies treat our planet and our people is starting to matter and will only matter to a greater degree over time.
I'm glad you brought that up because there is still a lot of noise out there suggesting that you do not get the same financial returns with this kind of investing that you get with traditional investing. And we've talked about that in earlier sessions. We talk about this a lot in the book. You just pointed to a very recent study that was done, but there are literally dozens and dozens of studies. And some of them have looked at as many as 10,000 different funds and done comparisons. Others have looked across all the research that's been done in this space over a period of literally decades. And again and again and again, they find that ESG investing in the stock market does not result in inferior returns. And actually, you see oftentimes better returns. And we even saw that during the market downturn a year ago. So a lot of naysayers were saying, yeah, we see that evidence, but when we hit a market downturn, then this is not going to hold up during that. And that is absolutely not what we saw, right?
You hit the nail on the head, Janine. It was really interesting to watch. ESG funds performed a lot better than their non-ESG counterparts in the wake of the COVID crisis. I think to many's surprise, but I think there's actually two reasons that might help explain that. The first is that I think ESG is increasingly becoming accepted as a proxy for quality. So kind of going back to that traditional fundamental analysis we're talking about, where people are looking at price to earnings ratios and other metrics to judge a stock, is not taking in a whole host of qualitative factors that are very, very important, like how sustainable or fragile their supply chains are, or the diversity of their companies. And so quality really matters when you hit a downturn. And I think ESG just had a really, really strong case study for that during COVID. And then I think a second component is there's a sector story as well. So positive ESG companies are often found in sectors like technology and healthcare, which did really well. And they often tend to be underweight traditional fossil fuels. And that was another really tough sector in 2020 as oil traded negative. So I think it's probably a mix of both of those things, but the former being, quality is something that will matter and will endure for sure.
Well, I think there's a lot of effort going on as well to come up with standards for ESG. And I think that we will eventually get there. But until we do, the point that you made earlier about really paying attention and really doing your homework, I think is right on the mark. And one way that you can do that is work with a financial advisory firm like your own. Another is for people who maybe don't feel like they have enough capital to do that or don't want to do that for whatever reason. There are actually a number of tools online, whether you're an individual stock picker or whether you are a stock fund person. There are tools online that you can use to help you figure this out. So you don't have to do this all alone. And we talk about those in the book, and we also point you to specific tools you can use and links to them on our companion website. So we help people make this decision process a little bit easier. And it's, I have found in my own portfolio, I've told people before, I experiment a lot. So I hold non-values aligned stock funds, and I hold values aligned stock funds as well. And my values aligned ones are absolutely outperforming, and they have been consistently. And the non-values aligned ones I hold are very commonly known and highly regarded funds. So we will help you find the things that matter to you. You mentioned the sector story, and I think that that's important because what you're getting at is an issue of diversification in your public equities holdings. So I think we've talked about the idea of diversification before. I'm not sure that people fully understand the level of diversification you can have within your public equities holdings as well. And one of the areas, for example, is that you can choose to invest in different sectors. So since you brought that up already, why don't you say a little bit more about what these sectors are and why someone would want to consider diversifying across them?
And I'll start at a very high level. I think there are a couple different ways you can diversify your equity portfolio. And the first one is really kind of geography. So I think a lot of our listeners may be based here in the US, and many investors tend to invest with a home bias. So that would mean folks who are living in the US have a fair amount of exposure to the US. But if you look at a global equity benchmark or index, the US represents about 50% of global equities by market cap. So 50% of a global equity portfolio would be outside of the US. So there's certainly ways to diversify geographically. I think another way is, of course, sectors, as we were talking about, Janine, and that's really investing in different sectors of the economy. So think of different types of sectors would be information technology, healthcare, consumer staples, materials, energy, and industrials, utilities. So it's really making sure that whatever fund that you're investing in is diversified across industries, because depending on where we are in the economic environment, certain industries tend to do well and certain industries tend to lag. So you want to make sure you have a nice mix there. And then I think another way you can diversify is by size of company. So you can invest in very large companies like Apple, or you can invest in smaller cap stocks and companies that are maybe more, companies that and are more specific to your area. So I think certainly it's important to have a diversified portfolio across all of those topics, across geography, company size, and sector.
And I think that becomes more important the larger your asset base grows, in fact. Now, I just want to say one of the words you used a couple of times is the word cap. So I know that that's probably a very common word for you, but just for some of the people who are listening, what Lauren means by that is a market capitalization, or a cap stock refers to the word capitalization, and it means how much money is that thing is worth. So market cap would be how much money is in a particular market. In reference to what Lauren was saying, that would mean in a particular country, for example. And a company cap size is how much that company is worth. So you can have things that are mega caps, which can have valuations in the trillions of dollars, all the way down to nano caps, which would have valuations in the single digit millions, perhaps. So that's what she means by that. And one of the things that people get told frequently is that they should just buy an index fund that holds the market, and that's all they need to do. So what that means is an index fund is a type of stock fund that is, the companies that are included in it are determined through algorithms and through mathematical equations. And these index funds sometimes will hold hundreds or even thousands of individual companies. So if you buy an index fund that is trying to align with everything that's in the S&P 500 or everything that's in another index like the Russell 1000, you would have literally thousands of companies. Do you think that strategy of just buying an index fund and holding it for 20 or 30 years is a solid investment strategy for individuals?
You know, that's a good question, a very good question. I think if someone wants exposure to the stock market and wants the simplest approach possible to do so, that is probably their best strategy, is to just have a long-term buy and hold in a passive strategy. That said, I think if investors are willing to spend a little bit more time and build more of a custom strategy, it is in our views helpful to have actively managed funds in addition to passive funds, which is where you're paying a little bit more, so the fees are higher on active funds than passive funds, to hire a team of portfolio managers that is trying to outperform an index. So if you were trying to invest in the S&P 500, you can invest in a passive fund, or you could hire an active manager that's maybe picking 50 to 100 stocks that are in the S&P 500, but that portfolio manager has some ESG information or fundamental information about the stock that makes them think it will do better than the S&P 500 over the hold period. So we like to use a mix of both actively and passively managed funds when we build portfolios for clients.
And that's what I have too. And it's one of the things that you and I talked about in the past, and you taught me. So active, just to recap, means that there are human beings that are making the investment decisions. They decide what to buy, how long to hold, and when to sell. Passive funds mean that technology is making all of these decisions. There are no human beings involved. So that's why you see the difference between fee structures, which we're going to come to in a moment. But one of the things that we had talked about, because you could invest, for example, in an index fund, a passively managed index fund, and that is one of the definitions of index fund, is that they're passively managed with very low fees, that is holding the majority of the largest capitalized companies in either the in the New York Stock Exchange and or the NASDAQ, right? So you could hold that. Or you could decide that you want some of your assets in European stocks, or you want some of your money in stocks in what are called the BRICS, which are emerging markets like Brazil, Russia, India, and China. Now, in the US large cap index fund, you may be able to use an index fund there and be at par with some of the active managers at that level, because there's so much publicly available data that helps those indexes actually figure out how to make their investment choices, right? So I'm saying this because I want you to confirm whether I got this right, Lauren, whether I learned correctly from you. So in something like a large cap US index fund, there's enough publicly available information that that kind of fund might be on par with an actively managed fund. But if you're looking at investing in bricks, for example, as I mentioned a moment ago, the publicly available information may not be sufficient to do the indexing as well as an active manager could build a portfolio, because they know more information and they're more aware of things that are more privately available information. Did I get that right?
Yeah, you got that perfectly right. And it all comes down to kind of this term in finance called market efficiency. And, US large cap markets are relatively efficient. There's a lot of price discovery. There are, as you mentioned, Janine, often 20 analysts covering each stock in the US large cap segment. Whereas in emerging markets and some international markets, there's often very few or no analysts covering those stocks. And so there's much more opportunity for active managers to generate what we call excess return. So return over the benchmark that the passive funds would be using and that these active managers are trying to beat. There's much more ability, and we've seen that the excess returns that active managers generate outside of the US have been stronger than those inside the US. And I do think it comes back to market efficiency.
Right. And I worry sometimes, and I'm really curious on your thoughts on this, but I worry sometimes around this conversation of just buy an index fund and hold it for 20 or 30 years. I worry about that for a couple of reasons. One is you should never own something that you just never look at before. At the very least, even if your goal is the simplest way of investing, for which that could be a good strategy, please at least look at your investments at least once a year and look at them against benchmarks and look at them against other investments of like kind to make sure that the return that you're getting is actually reasonable. I know women who have had this strategy, buy and hold, and when you look at what they're holding, they are underperforming dramatically. So please at least look. That's one thing. So, and the other thing, it worries me a little bit because when so much money is rushing into index funds, which is what's happening now, I've actually been reading some things where people are growing concerned about this and saying that it is actually it has the potential of corrupting the market, if you will, and that it's too easy for a big firm that holds a lot of index funds to by removing the money to dramatically change what's happening in the market. Do you agree with that? And do you have any concerns about so much money rushing into index funds?
I agree with that. And yeah, it's something that we are very, very mindful of. We have small passive positions in our client portfolios, but we've actually mostly rotated to actively managed funds and separately managed accounts because of how much money has gone into passive investing. And one point that I want everyone to understand, Janine, is when do you need active management the most? I think that's when markets are expensive. So if things have done really well, which we're hitting new market highs in the US almost, it's been a very strong environment for markets. Passively managed funds are by definition going to go down as much as the market. because they're tracking the market. But where active managers have tended to really earn their keep is during down markets. So if you think things look expensive and we haven't had a down market in a while, that's definitely a time to get really smart on what you own and make sure that you're well positioned for any potential market volatility.
And this is where I think financial advisors can really be helpful for those people who want to go that route and or who have enough assets to go that route. So I do think it's a smart decision at some point to have a financial advisor, because they are very well educated in this, as you can see from listening to the way Lauren answers these questions, how much she knows. They're very well schooled in this, and they also really have the ability to identify some of those better managers, which is a big task for those of us who are not living and breathing financial analysis and our money all the time. But you brought up another term that I wanted to get to, which is a separately managed account. So what is that, and how do you work with clients to develop those?
Yeah, it's a great question, Janine. A separately managed account is an account where an investor owns shares of stocks directly. So instead of logging in to your account and seeing one fund, that's one line item that you know owns 50 to 500 stocks, you'd log into your account and you'd actually see those 50 to 500 stocks. So you'd own shares of stocks directly. And part of the reason we like this is because oftentimes SMAs can be less expensive if you have a certain level of assets. They can also protect you and insulate you from exactly what you were talking about, Janine, which is some of the pressures that being in a more retail-oriented ETF or mutual fund, you might be subject to retail selling. That would not hurt someone who has an SMA where they're owning the stocks directly. And then the third piece is, this is really the rise of the personalization of your investment portfolio. We could literally build you an S&P 500 stock fund where we say, okay, maybe you're investing for your daughter who's quite young and she has a long time horizon, so willing to take a little bit more risk. We might invest in more growth-oriented stocks. And then you could also align with, you could do a values alignment overlay onto a separately managed account. So there are a lot of neat features, particularly around customization with separately managed accounts or SMAs.
Right. So people can do these themselves too. This is basically, an SMA is basically, I am buying a bunch of different stocks. I want probably about 50 of them to have diversification. As an investor, I could choose to make those decisions myself and manage my own portfolio. That's absolutely something that's possible to do. It's also possible to go to a financial advisor who offers this kind of service, and not everyone does, but someone who offers this kind of service, and have them build that stock portfolio specifically for you, to your particular values and to your particular return expectations. Now, there's something that's new coming on the horizon that I think is super interesting, called direct indexing. And I know that you have been working with some companies that do this. I'd love it if you'd explain what direct indexing is and how that works.
Yeah, it's an excellent question. And it basically combines two topics we've been talking about. So it combines separately managed accounts with index funds. So you're basically able to build a passive index strategy that's tracking a certain benchmark of your choice. So maybe it's the S&P 500. But the direct means that because you're kind of replicating an index inside a separately managed account, you're able to then make various tweaks to that portfolio that maybe align with your investment objectives or your impact or values alignment objectives. So it's really neat. We're living in a world where you can take the S&P 500 basket of stocks and build a diversified portfolio that's maybe tilted towards more growth-oriented stocks or stocks that have, diversity across their company or different topics that matter to you.
So because I experiment a lot with my money, I did this one too. I mean, I've done a lot of things. I've taken little bits of money and I'm like, okay, I'm going to try that. Okay, I'm going to try that. And I've worked with a company called Ethic, which I know that you work with as well. And here's how that worked for me. I mean, basically, they gave me a questionnaire that I filled out. And that questionnaire was asking me to identify the values that mattered to me. What mattered to me around gender diversity? And they drilled down to a lot of specific things. Did I care about women on the board? Did I care about pay? Did I care about the workforce? What aspects of gender diversity did I care about? They asked me this kind of question for a variety of different ESG-like topics. And then what they did was they took some assets that I already held in the stock market, and they applied my own index to those assets and came up with a aligned portfolio for me. And they told me how much what kind of tax burden I would have if I made the shift. They told me how closely the new set of holdings would align to a particular index, et cetera. And what's really interesting to me about these direct index options is in a separately managed account or in an actively managed account, as we mentioned, you're likely going to hold dozens of to maybe 200 individual stocks. In an index fund, you can hold hundreds or even thousands of stocks. Same thing with an SMA. In an SMA, maybe under a couple hundred stock, but in this direct indexing, you could hold thousands of stocks, and the decisions are made in the same way mathematically and algorithmically, just like they are in a typical index fund. But in this case, the rules and the criteria are yours. You set it up. Now, the challenge with these things today is that you have to put at least $250,000 into this kind of investment in most cases. And you have to go through a financial advisor because there are only a couple of companies that offer this kind of service. One is Ethic, one is Just Invest. There may be others. Those are two that I'm familiar with. So it's not for everyone yet. But the good news is that I've already heard that there are players out in the market. Lauren is shaking her head, so she may know more about this than I do. But there are already players in the market who are looking at providing this type of indexing for anyone. So do you know more about that, or who some of those players might be, or when that's coming?
Yeah, I think it is coming. It's hard to know. I think we're probably a few years away from that being fully democratized. But there are lots of groups like Wealthfront and other wealth advisors that are, and I know of a few impact startups. We'll see kind of who gains traction, but that are making SMAs available with very low or no minimums through the use of fractional shares. So that means, the reason Janine was talking about Ethic and Just Invest and some of these others have minimums is because in order to build a diversified portfolio of stocks that align with your index rules, you need a certain amount of each of those shares. But now that folks are starting to figure out how to own fractional shares, you can build diversified portfolios in a separately managed account format for much, much lower minimums. So I think stay tuned on that one. It's coming and quickly.
Yeah, I'm excited about it. I think it's really great. I mean, I get really excited when I hear about things like crowdfunding or this kind of, or some of these robo-advisors, what they offer, and the ability for anyone to be able to invest in much more creative ways. And again, this is why I think that buy and hold strategy worries me, because things change so fast. I mean, I think about my mom who used to invest in individual stocks. She had a buy and hold strategy. And when she passed away and we looked at what she held, she had companies that basically, she had bought into companies that basically had gone out of business. She just, at some point, she stopped paying attention because she was older and she didn't care anymore. But they literally, her stock had gone from amazing highs to almost worthless because those companies had gone out of business. Things change, and we need to be aware, and we need to keep our eye on the ball, even if it's only once a year, and even if we're going for that index strategy. But what we're talking about right now brings me to one last point that I'd like us to get into. Part of the whole benefit of some of these index funds, as we've mentioned, is the fees are low. So I know that there are certain people, and I'll bring up my mom again, because she was one of these people who absolutely hate to pay fees. She hated it, hated, hated. It was like her mantra. So, and I know there are a lot of people out there who have a similar belief that you do anything you can to avoid paying these fees. So what are your thoughts about fees?
Yeah, it's such a good question, Janine. And I think the fees thing, we see a lot of different types of investors, and some of whom, it's kind of that bird in the hand philosophy where they just want to pay as low of fees as possible. But I think, you've got to think about investing like you would healthcare or education or any other important part of your life, which is that, you get what you pay for. And I started out, my kind of first rendition of my personal portfolio was very much cost effective. And that was my goal in the beginning, because I had, a smaller portfolio than I do today. And today, as my assets have started to grow, I've changed my priorities. I've really started to, and by most people's standards, I probably have a very high fee burden portfolio, but that's because I have most of my investments in values aligned investments where I've met the human who's running the portfolio. I have a lot of trust in that individual, a lot of women in the portfolio. And, I think what's really important is to build a portfolio that has a strong risk return profile net of fees.
Right.
And so I would not shy away from high fee portfolios, because I'll give you an example. We had a global impact equities manager in our portfolio last year that returned 70%, and the benchmark returned 20%. If you're worried about paying a 1% fee versus a 0.1% fee, yet you were up 30% like an index fund, or up 69%, that 70% minus the 1% fee, I think all of us would take the 69% instead of the 30% all day. So I'd caution from letting fees alone drive your investment decisions.
I really agree with that. I think that the goal is the net return. That's what matters. And so fees are important, but if they can be the tail wagging the dog, right? So I think that that's really, really critical. Well, this has been a great conversation. I really appreciate it. Do you have any last thoughts or anything that you would love to leave our listeners with before we close?
Yeah, I'd love to say, first of all, it was great to chat with you, Janine, and thank you for creating Activate Your Money. I think this is going to be a phenomenal resource for our listeners and for women globally building portfolios for themselves. And I hope everyone leaves this conversation thinking that no matter how much money you have, you can, in today's environment, you can have an equity portfolio, and you can have a public equity portfolio that is aligned with your values. So looking forward, I know we have a lot of resources, Janine, with Activate Your Money to help folks do just that.
Well, thank you so much for that. And I really want to point out to everyone, Women like Lauren are exactly the reason that I had so many women help me with this book, because she's smart, she's successful, she is a general manager at her firm at a very young age, and she really knows her stuff. And there are a lot of women out there like her who are great resources for all of us as we go down our financial journeys and our investment journeys. And part of the goal with the book and the website and everything else we're doing is to really help highlight the fact that there are women like Lauren out there. And I know some things about investing, but she knows a lot more than I do. And so I really appreciate having her and having all the other women who have been helpful in this project as resources for me and as resources for you. And our goal is to just keep finding them and growing this base of women who are out there helping other women be smart, confident investors. So thank you again, Lauren. I really, really appreciate your time and all your insight and all your help along this journey. So we will close this session here, and I want to invite you to join us next week for what is going to be a significant shift. So up to this point, we've talked about some of the foundational things you need to think about when you're investing. And we've also talked about the three main asset classes that people tend to consider, which are their cash, their fixed income, and their public equities. And all of these are publicly available investment opportunities. Starting next week, we're going to talk about private investing. So we're going to go into what it takes to invest in private debt, in private equity, and what it looks like to be an angel investor. And for those of you who think that you have to be wealthy to do that, think again, because it's actually possible as a result of regulations that came out a couple of years ago and crowdfunding for anyone to invest in private deals for as little as $100. And we will talk about some of those opportunities in our next session. So please come back and join us again. Thank you so much for listening.